Good morning and welcome to this Wednesday, May 20th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. We got another strong morning as far as futures go. Looks like the market's going to try to resume its recent move to the upside. That's probably one of the top stories again as we saw a big sell-off at the end of the day yesterday, and looks like the market wants to, try to make another run for it here today. We'll see. Let's go over some of the things I want to talk about today. Of course, I'll go through the daily market recap. Talking technically, I want to talk a little bit about breakouts. I'll show you how you can go through the predefined scans, find yourself some 52-week highs if that's the way you like to trade. Also wanted to go through a few industry groups, especially in the consumer discretionary area, because consumer discretionary has really picked up if you haven't been paying attention on a relative basis to the S&P 500. And a lot of the beaten down areas are starting to show more strength in that group, which is just adding to the strength that's already been in the group from some of the leaders. So I think the consumer discretionary area is one really to give some love to today. And then we'll get into some earnings that came out last night and this morning, several companies. A cruise line, one of the cruise lines reported. We'll talk about that. And then upgrades and downgrades. There's a railroad or two, I think, in there. Railroad's trying to make a little bit of a comeback here. One in particular that we followed closely over the last few quarters on the verge of a breakout. And then we'll wrap up the show with 3 you must see. But first, before we get into any of that, let me just take you to our website over at earningsbeats.com. Just want to make sure you're aware we have 3 times a week newsletter. If you're not already getting this, it's free. There's really no reason not to get it. Name and email address is all it takes. You can subscribe Monday, Wednesday, Friday. I usually just write a quick blurb about a stock. Sometimes it's an industry, but usually it's a stock. Could be earnings related, could be technically related, could be relative strength related. We focused a lot on accumulation distribution. I think that's another area you might see from time to time on this newsletter, but I think it's very educational, just trying to teach folks about the market and some of the things that you should be looking for, maybe in stocks you own or are thinking about owning. Also, we just had last night our biggest event of the quarter. That is where we unveil our top 10 stocks in our 4 portfolios. If you'd like to become a member, you can go back and review that recording. You can download the chart list right into your account. If you're a Stock Charts member already, at least extra member or above, you can take all the chart lists we do, and there's probably, 7, 8, 9 of them now. I can't keep track of them, but you can take those, download them in seconds into your account at Stock Charts and be ready to trade off of them. I think it's a powerful tool, but you can simply follow this, click here to join. It'll give you an idea of some of the things that we offer, and then just simply follow the Join Today button and sign up. It's $7 initially, but we're going to fully refund that to you. So it's seriously, it's $0 for a month to get all these chart lists, check out the portfolios, check out our process, the way we do things. I think you'll enjoy it. If not, you've lost nothing over 30 days. All right, let's move on to the market. So yesterday we saw the Dow Jones move down at the close. Really some selling late in the day. Dow Jones down 390 points, 1.5%. S&P 500 down 31, a little more than 1%. NASDAQ actually outperformed on a relative basis after Monday's relative shellacking. I say that. It was still an up day on the NASDAQ, but the NASDAQ underperformed on Monday. It did come back yesterday. It was down, but it was down less than the overall, the benchmark S&P 500 and Dow Jones, but still down 50 points yesterday, down about 0.5%. Mid caps down 1.3%, 21 points, and small caps really took lumps, down another 2% yesterday after a really strong day on Monday. I'm watching this group though. I don't know. I think that the small caps are going to bounce back in 2020. Maybe it's just a gut feeling. Maybe it's just being hopeful. But this is a group, along with the mid caps, that have been underperforming the S&P 500 for an extended period, probably one of the longest underperforming periods for both small caps and mid caps this century. So, I mean, we're talking about now a couple years that they've been underperforming, and it normally flips. You know, when you go this long, normally we'll see a rebound in those smaller companies. So that's something I'll be looking for as we continue to try to come out of this pandemic. Energy stocks, looking at the sectors, energy stocks down 3%, financials down 2.5%, real estate down 2%, staples down 1.8%. And on the flip side, communication services lost a penny, 0.01 on their index. That was the best performer. So all 11 sectors were down yesterday, but communication services, which has been one of the strongest performers, and you can look at how communication services coming off the bottom continues to put in higher highs and higher lows. And you look across these other four that had rough days yesterday, they've been having rough days on a relative basis throughout much of this pandemic. And it happened again yesterday. Now, as we see some of the areas improve, I'm hopeful that some of these weaker areas will also see breakouts. I mean, energy seems to be right on the verge near that $40 level. It'd be nice to see energy break out. Financials got a double top up there near 23.5, 23.75. Real estate's in this downtrend. You can connect these highs. Same goes with staples. It would be nice to see all these groups break out. That would just add to the bullishness that we're seeing in the aggressive areas of the market. Some of the aggressive areas. Financials I would consider aggressive, but they certainly have not done well with the 10-year Treasury yield falling the way it has. And speaking of the 10-year Treasury yield, let's take a look at what happened there and what's been happening. This goes back since the year 2000. So you can see clearly we're in a downtrend, but we have been in free fall. This isn't a downtrend. We've been in a free fall since the start of the fourth quarter of 2018. And that's when the trade war began. That's when we were at 3.25%. That seems like ages ago. 10-year Treasury yield at 3.25%. Now we're at 0.72%. Got folks like President Trump love to see Treasury yields go negative. You got others saying, hey, we don't want to go negative. Got the Fed saying they're not going to go negative. I don't really know where I stand. I do know this, that when you've got low interest rates like this, if you've got companies able to grow their earnings and provide good forecasts, they've got management teams that you can trust, earnings multiples should be through the roof. I'm not talking 20, 30 PE. I'm talking, some of these companies, these small companies, you could see hundreds, their PE in the hundreds because their earnings grow so fast. A company that goes from 10-cent loss one quarter to 10-cent profit the next quarter, you're not going to just say, well, the PE should be 20. So let's see, 10 cents a quarter times 4 quarters would be 40 cents times 20. They should be $8. That's not the way it works. When you've got a company that's growing that fast, earnings can go up very, very quickly. So pricing a company at 20 times PE is not practical. Really, you need to look at price earnings growth, the PEG. That gives you a little bit more information. And you're taking all of these future earnings, which are going to expected to grow rapidly, discounting them back at current rates of interest, which are almost zero. And so you're going to have tremendous valuations. And I think that's what the stock market's going to have to come to grips with, because unless interest rates start shooting back up, which I don't believe they're going to do, I think the Fed's going to wait for a while to make sure this economy's back up and running. So I think these companies that can benefit over the next year while interest rates remain incredibly low, I'm not sure you've seen even you've seen the beginning, but I don't think you've seen the end of how much higher some of these companies can go. All right, so let's talk a little bit about looking at these 52-week highs. So if you go into your dashboard at Stock Charts and you've got everything set up like I do, where you've got all these different panels, and if you don't know how to do, if your dashboard doesn't show all of this, make sure you go over here to this panel, or this gear shift, I call it. And if you click on that, this will tell you what you have checked. And you'll probably see, if you don't have much, you'll probably see that these aren't checked for you. And so you just want to make sure you have the scans, the chart list panels, commentary, additional data panels. Make sure they're all checked. And then that'll lay this out. And then when you come down to each of these panels, you can change, scooter reports. You can change the ticker cloud, your predefined alerts, decision point, if you follow decision point signals, scooter reports, market movers. Sector summary. I mean, you got all kinds of different things. I like setting mine to scooter reports. I like to have large cap, mid cap, small cap. So I can quickly look at what is moving in terms of scooters, which ones are really, starting to move up into that 80, 90 range. So you can see here, Salesforce.com jumped 9 points to 88. A Biomed up 17 points to 82. These are starting to move up in their relative ranking versus their peers. That doesn't necessarily mean I'd go in and buy the stock, but it means, hey, maybe I should be looking at it, see what's going on. So this is just, for me, just a quick little, view of some of the areas I might want to go take a look at, which I think is important. And I've got major market indices up here, scan results. Sometimes I'll switch those back and forth. But what I wanted to show you was down here under scans. So you can go into this more little button here, and you can bring up predefined scans. Now, right there at the top, new 52-week highs, and you can see there's a ton of different scans. And you say, well, I'm not really interested in all. I just want NASDAQ. Well, there's the NASDAQ. There's 53 new 52-week highs on the NASDAQ. If you're somebody that likes bullish MACD crossovers, there's 58 of them on the NASDAQ. I mean, the stock charts is handing these to you on a silver platter. Just go in, find what you got, you like, and go with it. Now, if there's something in here and you really want to try to streamline it or change it, here's another cool feature. So here's the 52-week highs just on the NASDAQ 53. So I can click on this. Now, this will give me all of the stocks that are breaking out to the 52-week high on the NASDAQ, which is cool. I can sort them. I can sort them on sector. I can sort them industry. I can sort them in scooter rank, order, volume order, whatever. The other thing that's pretty cool here is up here, you can see click here to edit the scan. If you want to learn more about scanning, this is one of the best. This is the way I learned actually a lot, is by looking to see how they wrote the scan to get this predefined scan. So how would you write, if I wanted the 52-week highs on the NASDAQ, how would I write that scan? Well, you click there and it's going to tell you. There it is. That's how you write it. That's the language that you would use. Now, you can come in and say, well, you know what? I don't want the OTCBB, so I can just get rid of that. Gone. Okay. 40,000 volume is not much. I want to change that to an average of 200,000. And I want the 50-day volume, not the 20-day average volume. And so that's showing you the daily high. This is the real guts of it right here. That's how you write 52-week high. Inside those parentheses, you have daily high is greater than yesterday's daily max. So that's looking back over these 253 days, the max high over those days, the daily high was greater. So, if you don't write it exactly right, it won't come up. It doesn't work. So this is one way to kind of get used to how you write these. Now I could do something else and say, well, this is great on the NASDAQ, but I only want technology. Well, you can come down here and you can even look for your technology stocks, technology sector, add. And the group is technology. You can check your syntax, make sure everything's working. Okay, it says everything's good. Run my scan. Now that list has just been, I can look quickly at the 10 or 9 stocks here that are in technology that just set a 52-week high. All the scooters are in the 90s, as you would expect. I mean, 52-week highs, you're thinking that you got pretty good stocks. And take a look at the list. I can tell you right now, a number of these companies are on our portfolios. We are momentum. We like momentum. We like relative strength. So these are the types of companies that we would be interested in. But I just wanted to point that out because that's a really cool feature. And it's not just stock charts handing you something, but you could then, using the tools that they give you, you can see exactly how they write the scan. And it can encourage you maybe to, maybe configure it a little bit differently and put your own spin on it. So you can take what they've done and come down and say, well, give me what they gave me, but also throw in the scooter. I want the scooter over 75. Whatever it is you want to do, you can add to it. So that's one way to really learn easily what you can do over at Stock Charts. All right, let's talk a little bit about some of the areas, some of the industry groups that are starting to look a lot better to me. Broadcasting and entertainment. This was a group that wasn't doing particularly well, finally got above the 20, but it went back down below the 20. But let me show you something. It actually held some key price support. So that initial low right here, you can see a couple of lows coming down. Right here, we went down to 1,200, bounced up to a new high. Back down to 1,200 to a new high. Back down to 1,200 to a new high. As we keep moving up, putting in these higher highs, holding this support, this is critical. A lot of folks still looking down here at these March lows. I'm not looking at that. To me, that's in the way back in the rearview mirror. That's looking back a mile. This is, I'm just looking back a quarter of a mile. This is a key level to me. If we continue to hold these shorter term support levels where we've held multiple times and can break out from that, that to me is incredibly bullish. And broadcasting is an area that hasn't been, one of the leaders. So now we've got a group that's been a relative laggard that's starting to show more and more bullish signs. And when you get more and more and more of these industry groups and sectors that have been lagging, that are showing more bullish characteristics, I think you can forget about March and March bottom. It's just, the market's going to have to, something's going to have to happen to really weaken a lot of the areas of the market in order for this market to even think about going back down. All right, let's take a look at home builders. Home builders have really been strengthening. I think about where interest rates are. If the economy starts to pick back up, I refinanced, and I talked to members at Earnings Beats. We were in one of our war rooms, I think, a couple months ago, or a month ago, when rates were coming down quickly on the 10-year Treasury yield. That's one of the things I said. I'm pretty sure I probably said it on Trading Places Live as well. I mean, refi, if you can, go out and refi if it makes sense. I got 3 1/8, or actually I think it was 3 1/4% on my refi rate. I mean, housing is so affordable. Of course, we need a stronger economy, make sure we get people back to work. But this is a great environment for home builders. And now they're starting to show this technical strength. And I'm not going to annotate, but you see where we broke out from, about 710? That was the high. We broke out. Where'd we go back to? 710. This is bullish characteristics, breaking resistance. That becomes support. We hold it. We break out again. This is just bull market 101 behavior. How about broadline retail? Now, this has been a strong group, but broadline retailers with Amazon up there, threatening its breakout. Let me show you Amazon. It tried to break out, pulled back. We might see a little consolidation, but I think overall Amazon looks good. Again, if we consolidate, it brings back 2250 into as a possibility. We'll see. Or maybe we just go up and we break out. That's a possibility too. But the chart itself is very strong, and this is the Broadline Retail Index, also very strong. Next up is footwear. Again, these are all, with the exception of broadcasting, these are all consumer discretionary groups. And outside of broadline retail, these are all groups that had been lagging. Look at footwear trying to make that breakout above all these tops. See this support level here that's been holding around 1,500, kind of in this range. Now we're trying to make a breakout. Watch footwear. Next up, how about recreational products? Really strong recently. Beautiful move, rising above that 20-day moving average, holding the 20-day, breaking out to new highs again. I think recreational products looks really good. How about auto parts? Auto parts had a failed breakout yesterday, but I'd be watching this low down around 305 or so, 305, 307. Tried to make that breakout. I think we're sideways consolidating. This one is one of the few that we've been pulling up here. You can see the AD line's been going lower. So that's a little bit of a concern. But if we make the breakout, remember, there's nothing more important than price volume. So if we're getting the move up and you see the volume begin to tick back up, getting above some key levels, I would say auto parts are healthy. And yeah, I would keep an eye on it because of that weak AD, but I would not bet against a breakout. Just a couple more here. TT, this is travel, DJUSTT, travel and tourism. Breakout, not yesterday, the day before yesterday, when we saw a lot of the weak areas really strong back on Monday. Travel and tourism broke out to a 2-month high. Now, we're not challenging the all-time highs like the NASDAQ 100 is, but we're starting to make inroads here. We're starting to show some more strength. And what you want to see, we've been showing just consolidation signs. When you consolidate, you're not in a trend. That's when you go below the moving averages, above the moving averages, below the moving averages, above the moving averages. Kind of get that sense of we just don't have any direction. When you get direction, you start holding the rising 20-day moving average. So that's the kind of thing I'd be looking for in these weak groups. As they move up, when they come back down, do they test and hold their 20-day? If they don't, then you're probably still in consolidation. You're not in that, green light area just yet. You want to be a little bit cautious, maybe still that yellow light. But so far, travel and tourism doing well. Last one I wanted to mention is the DJUSBE, which is the business training and employment agencies, also trying to make a breakout. See the double top here at 100, broke out to 115. Where'd we come down to? 100 and the 50-day moving average, but 100 is what I'm really concerned about. Price support, we bounce. Now we're trying to challenge the breakout above 115. Again, sideways consolidation. That's better than downtrending. We're uptrending with sideways consolidation. Breakout would be bullish. More and more of these groups are looking bullish. I know, folks are still looking at these economic reports, and we got initial jobless claims coming out tomorrow, and they're going to be bad, although they're expected to be less bad than they were last week. I think we're looking like 2.35 million claims are expected tomorrow. Last week it was, I think, 2.9 or 2.95, something like that, million. But the economic news is already starting to maybe look a little bit better based just looking at initial jobless claims. And now you've got technical behavior where the market's, trying to go higher. I'm just saying, just be thinking if you're clinging to that bearish bias, I think you got to look around you. I don't think that the charts are supporting that right now. All right, let's keep moving. Got some earnings one to go over here. First one is NetEase. NetEase came out, they blew away their earnings estimates. They're in the internet space. Internet stocks are on fire right now. So that's good news. I don't know what the stock is doing here, but let's take a look. NetEase right now, it is barely up a little bit here in pre-market. But up is up. I mean, the stock is going up. It's been anticipating good results. It got them today. Let's see what happens. I mean, if this stock were to sell off near term, and we see it a lot right after earnings where you get this big down move, if it goes down below the 20-day and then comes back up above the 20-day, that a lot of times is a good time to think about jumping in. A lot of times that's all it is market makers making this big swoosh down, taking everybody out that got in before earnings, and then redistributing shares to institutions that want to accumulate the stock. And so market makers look like a hero. They go down, they get shares a lot cheaper for their institutional clients. They build loyalty with their institutional clients. Then the stock comes right back up. People that sold, that bought at 400 and sold at 360 are kicking themselves. And that's just the way the market works. Who else do we have here? How about, well, actually, let's look at the reaction first, since we got this already up here. Urban Outfitters, horrible numbers. Stock down 5% today. I mean, they came out with a loss of $1.31. The market was expecting a loss of 26 cents. Really, really bad. Stock was trying to make a breakout. It's not going to do it, at least not on the open today. If you were hoping maybe that the bad news was all built in, so far pre-market looking down. Let's see if we can make the breakout by the end of the day. But underperformers, I would not be expecting big numbers in their earnings reports. Wall Street sends out their analysts to these companies. They don't like what they hear. That's why these stocks underperform. They go back into their offices and they sell for their clients. They don't buy. Next up, let's look at Red Rock Resorts. Up almost 2%, 1092. It's up here near this breakout. Going to need some work. Another bad report. Stock was expected to earn 13 cents in the last quarter. They actually had a loss of 11 cents. So sometimes if you get the breakout with bad news, it's a sign that a lot of the worst is already built into the price. So let's see if we get this breakout. But I'm not a fan of that earnings report. And right now I would not be a fan until we see this breakout. Next up, we're going to go just look at the regular charts because these, or actually, no, let's just stay with these. These are companies that reported this morning. Lowe's came out, crushed estimates, $1.77 versus $1.29. Stock up more than 4% this morning, 122 and change. We're back close to that all-time high, or at least the February high on Lowe's. Really strong action here. Been talking to our members about these the companies in this area. Let me pull up the chart here, and we'll look at the relative strength on Lowe's. But look at the home improvement group. And this is, I've been talking about this now for a while. This group is starting to show some really good strength. Lowe's is showing about a 3-month breakout to a relative high versus the group. And look at home improvement relative to the S&P. This is where you want to focus efforts, or in areas of the market that are beating the S&P 500. Why are they beating the S&P 500? Because Wall Street's sending their analysts out to companies like Lowe's, and they're getting good reports. They're coming back in, they're buying before the earnings reports come out. Now, does that work all the time? No, not every company that looks good going into their earnings is going to come out with a fantastic earnings report. And even the ones that do sometimes will go down. It's a buy on rumor, sell on news kind of thing. But it gives you a lot of clues in the market. If you're just guessing, I think this company is going to come out with a good report. I think you'll do a lot better guessing if you look at the charts, see what's going on in the charts. Next up is Target. And then I'll show you a cruise line, and then we'll wrap up the earnings. Target up a little bit pre-market. Target also came out with a good report, 59 cents versus 46 cents. Stock getting very close to that February. Well, actually, this is earlier in 2020, beginning of the year, above 127, but we're getting close to those highs. Target looks good to me. And then finally, the good, the bad, and the really ugly. RCL, which is Royal Caribbean, is actually up. Their earnings report's horrible. Can they get through $50? That's going to be a key. So they're up, but they still got some work to do. Their earnings were expected to be in a loss of 81 cents. The loss was $1.48. I mean, it's kind of hard to make money if you don't have customers. I feel like that seems to be a pretty obvious conclusion. But, you know, with social distancing, stay at home, these areas where you're putting a lot of people together for entertainment and pleasure, these are going to be probably the last to respond. And they're probably going to need a virus vaccine. So I would expect that they're going to lag for a while. So there's your RCL, Royal Caribbean Cruises. Airlines kind of in that same mode, I think, of needing probably a vaccine, and we need to get beyond this. People need to start feeling a little bit better, willing to travel, all of those things, and have jobs so that they can pay for it. You know, let's not forget about that. That's a little minor detail, I suppose. All right, upgrades and downgrades. Let's go take a quick look at a couple of these. CSX upgraded today. I think that's looks like a pretty good looking chart. Higher highs, higher lows coming off of this bottom down here. I think overall the accumulation distribution line, not bad for the drop that the stock took back in March. We went down a little bit on the AD, but nowhere near where we were back, you know, 3-6 months ago when the stock was actually much higher. So we went lower in price, but we didn't go lower in the AD. So not bad. It's coming back, trending higher. I think this initial low right here down around 59, you want to make sure that holds. But otherwise, I think the stock looks like it wants to go higher. Also, JP Morgan upgraded today. Oh, the banks have been rough. They just got a lot going on. They're going to, you know, unfortunately, a lot of the companies that are doing well during this pandemic, many of them don't have loans. They're cash cows. You know, the Apples of the world, they don't have a revolving line that they're using at JP Morgan. They've got so much cash, they don't know how to spend it. So a lot of the really good areas of the market don't rely on the banks. The areas that are struggling and are not sure how they're going to make it the next 6-12 months, those are the ones that are bank customers, unfortunately. And so I think that's why we're seeing these banks getting hit so hard, even though 10-year treasury yields have been rising. The spread, which is a big driver for bank earnings, the spread's been going up, but JP Morgan, you can see, still struggling. All right, NSC, last upgrade. Let me give you a last upgrade. Just another railroad. Pretty much looks like the CSX chart. Higher highs, higher lows. Need to get that breakout above 180, but I think the stock looking pretty good. Now we're going to do the 3 you must see to wrap up the show. Market just getting open. First one up is ZBH. This is Zimmer Biomet. I really like what's going on here. First of all, look down here at medical equipment. Medical equipment is one of the better areas. So ZBH already has that going for it. But look at ZBH now relative to its medical equipment peers, breaking to about a 2-month high. So we're starting to see some relative strength there. And we're just breaking out above these prior highs, this double top. So I'm thinking ZBH could be ready for a little bit of a run here to the upside. I wouldn't be surprised, given the group it's in, given its relative strength improving, and now trying to make this breakout. This is one I definitely would keep an eye on. HPQ, the second of the 3 you must see. Downtrending. I think this downtrend, if you connect these highs, was, it looks like it was downtrending pretty solidly. But just recently, last 3 or 4 days, look at these hollow candles coming up. Accumulation distribution, which was not good, all of a sudden starting to take a move back up, and it's up again today so far. I think it's got room up to 18. Then we're going to have to see what it's made of, because after that big selling in March, that was the reaction high. So I think 18 could be a lid short term. Breakout there would be really bullish, but I would expect a pullback off of 18. Maybe you get another chance off the 20-day moving average. But HPQ, even though it's been a very weak stock, look at it relative to computer hardware. Computer hardware has been a great group. You don't want to be in a weak stock within a great group. You want to be in a great stock within a great group. So I can tell you, Apple is a stock you want to be in computer hardware, not HPQ. But we are starting to see strength. Watch those levels I just talked about. And then the last one, another railroad I want to mention, because this has been one of my favorite railroads for quite a while. Kansas City Southern, it looks like it's just making this breakout today. Now, railroads, and you can see Kansas City Southern Corp. KSU, relative to the railroads, was really moving well into late March. And then it started to struggle, but we're starting to see that begin to pick back up again. It's beginning to outperform the S&P 500. Railroads trying to move to about a 3-month relative high. We'll see if we can make that breakout. And KSU just making this breakout. So if you're looking at something maybe that hasn't been real strong, you're tired of looking at all the technology and healthcare stocks that have been just exploding, you might want to look at a company like KSU. It just bounced off its 20-day moving average. It looks like it's trying to trend up, making the breakout in a group that's starting to improve. The stock's improving. Anyway, just thought it was worth mentioning. Let's get a quick update on the market, then we'll wrap this up. Futures held right into the open. We got the Dow right now up 290 points, S&P up 36, NASDAQ 129. All of them you can see up well over 1%. Small caps, mid caps also up almost 2%. So they're actually leading today. Probably the one thing I'm going to be looking at today as much as anything is continuing to watch those chart lists. And Earnings Beats members know what I'm talking about. The strong AD, the weak AD, the strong earnings chart lists, to see where Wall Street is favoring on those lists. Are they going after the companies that are showing the strong fundamentals, the strong earnings chart list? Are they going after the companies that have been accumulated over the last 2 months, the strong accumulation distribution chart list stocks? Or are we starting to finally see that rotation into stocks that have been very, very big laggards over the past 2 months? That would be the weak accumulation distribution or weak AD chart list. That's going to be my focus, not just today, but really, I'm going to say probably for the next couple weeks to a couple months, is looking to see where Wall Street is moving its money. Is it ready to rotate back to the cruise lines and the airlines, or maybe not even those, maybe the railroads, as opposed to continuing to chase prices up in technology and healthcare? Those are going to be some of the questions. I think technology and healthcare continue to go higher in my view. It's just whether or not they lead. That's the question. So, and we'll see. Those are some of the things I'll be looking at. Anyway, let's go ahead and wrap up. Everybody have a great day. Tomorrow morning, I'll be doing that pre-recorded version of Trading Places Live over at Stock Charts TV at 9 a.m. Hope you join me there. Anyhow, everybody have a great day. Stay safe and happy trading.